to my Welcome back to my YouTube channel, Trade with Ademola. And in this video, I'll be explaining to you the basic SMC, like how you can basically understand SMC, how you can start going about it and start taking your trades, and how basically you yourself can start taking trades and making money by yourself without waiting for signals or waiting for people. So without wasting much over time, let's dive into what SMC is all about. So let's start with the definition of SMC. What is formula of SMC? SMC is the formula of SMC is smart money concept. Smart money concept. So what is this strategy trying to tell us? This strategy is trying to explain to us the ways and how you can start trading like these institutional traders, these people who basically who their money basically moves the market. Because me and you are just basically retail traders. We're just here to make our little money and leave the market. Our money has little or no effect on the market. So what do we want to do? We basically don't want to trade against people who have huge capital, huge funds to move the market. What do you want to do? You want to basically trade with these people who have big capital, big funds, to trade with them, to make money with them. So society is just basically explaining how these people make their money. I think I'm making sense. So in trading with this strategy, we have some basic concepts in it which we have to basically understand, and I'll be explaining everything one after the other. So what's the first thing? The first thing here, you have to understand what an order block is, which I'll be representing with OB. An order block or a breaker block is BB. The next one is inducement, which I'll be representing with IDM slash liquidity. Then followed by FVG, fair value gap. FVG, fair value gap. Then followed by break of structure, which I already explained in my first video. So if you haven't watched my first video, please go back to it and watch it, which is where I basically break down what break of structure is, and change of character, or MSS, market structure shifts. So these things which are listed here, order block, breaker block, inducement, liquidity, value gap, breaker block, break of structure, and market structure shift, are basically what make up this strategy. So all these concepts is what you are going to combine together before you start trading this strategy. So what is an order block? An order block, an OB is the last opposite candlesticks which cause an impulsive move or break of structure, which cause a break of structure, let me put it that way, cause a BOS. So another block, before we can mark for another block is the last opposite candlesticks. So this last opposite candlestick, if you are buying, like if you are going to take a buy setup, your order block should be you marking the last red candlesticks which cause a break of structure. What do I mean by this? You might have something like this in the market. You have price doing something like this, breaking higher low, higher low. So before you have this after having this your correctional move, then you have this your impulsive move, then you have a break of structure here. So this strong move to the upside, there, that came to break structure there and give us a new break of structure, you will go down to that last red candlestick, last opposite candlestick, which caused this thing to give us a break of structure. Then you map it out and drag it out. What am I trying to explain? For instance, we have an impulsive move here and a correctional move here. After this correction move ended. Then we have another positive move which caused a bigger structure here. So we go back to check the last red candlesticks which push price up to break this structure. Then we do what? We bring out your rectangle, drag it out. That is where you are going to mark as your order block. Now let me go to the chart and show you what an order block is. Now in this chart, let me clean it up. You can basically see that after price broke structure here, it gives us a correctional move, then went up, then break this structure here, then we come down and check the last candlestick that caused this break of structure, which is this red candlestick, and this is what we are going to basically map out as an order block. So that is another block. And what is a breaker block? In a breaker block, it's just a failed order block. Just simple language and simple explanation. A breaker block is just a failed order block. A BB is a failed OB. So for instance, I said when price is moving to the upside and giving us series of break of structure to the up or downside, having this as a break of structure to the upside, what are you expecting? You are expecting market to come back into this our order block, which is our demand zone, then the price will push forward. But instead of this price doing that, instead of the price coming into this order block and move up, it came down and violated this order block, then it came down. Then that way, turning this an order block, this are bullish order block to a bearish order block, then making it as a breaker block. So what are you expecting market to do? You expect price to come back into this zone and start selling again. So another block is the last opposite candlestick which cause a break of structure or which cause an impulsive move. Then the breaker block is a failed order block. I think I'm communicating. Now, what is the next thing we are going to look at? An inducement or liquidity. There's a saying that said you should be able to spot the liquidity, because if you find it difficult to spot liquidity, then you become the liquidity. So an inducement is just a liquidity in the market. So I want you to know that there's a difference between inducement and liquidity. An inducement is a trap, is a way of trapping retail traders into making wrong decision. Let me come again. An inducement is a way of trapping retail traders of making wrong decision in the market. So a lot of retail traders are impatient. So these smart money traders, what are they doing? They will try to place trap in the market. Everywhere in the market, you see those traps there. Them putting those traps there is for you to make what? To make wrong decision, so that they can liquidate you and start making before they make their own major move and make their own money. So what is the basic difference between this liquidity and inducement? Just that every inducement is a liquidity, but not every liquidity is an inducement. Now, inducement is trapping you to be a liquidity, but liquidity is not an inducement. Liquidity can come in different form, but basically, I just wanted to know that inducement is the liquidity, but not every inducement is a liquidity, but not all liquidity are inducements. So that is just the basic explanation I just want to give you. So an inducement can come in different form, but one of the major major ways of you marking your inducement is a major pullback or a valid pullback after your break of structure. A valid pullback after your break of structure. So I said something that we are going to mark our order block as the last opposite candlesticks which cause an impulsive move. Now we have this order block here. After we have this order block here, we then have a break of structure. After the market came down here, we have a break of structure, maybe somewhere around here. Sorry. We have a break of structure somewhere around here. Then we have this pullback. This pullback coming down into this. This is our pullback now. It's an inducement because why? A lot of people who are already map out this other block as our buy zone. Then seeing markets coming to close to it, then we prepare to take our buy order. But instead of the market tapping into it, we see that the market didn't tap it and just came close, then start going up. A lot of little traders, impaired traders, will jump into the buy so that they won't be like, so that they won't miss out of the trade. Then jump in it. Then these people will trap them in, making them to see like profit. They will think they are already making profit, and if they didn't take their profits, the market's coming back into this our demand zone, give them stop loss, then moving. So you see our stop losses, our break even and the likes, they are liquidities to the market, but are not inducements, they are liquidities. But liquidities, the inducements are these traps that these people are setting into for us to make condition. You can see, you can also see situation of general liquidity. And liquidity is like you already mapped to your other block, then market didn't give valid pullback, but the market do something like moving close to your or other your order, then moving. After moving a little bit, it came back there, trap other people out and start moving. So your inducement, the major inducement you should try to notice in every trade is your first major pullback after your break of structure should be your inducements. So I think I'm clear on that. But your to mark your liquidity can come in very form. You can have double top, double bottom, different ways of maybe mapping your inducement. But major one of you marking your inducement is valid pullback after the break of structure. Then after then we have a fair value gap, FVG. Fair value gap, FVG. So the market will like FVG is just an imbalance in the market. Fair value gap, fair value gap, value gap, value gap is an imbalance in the market, so that's just what an a fair value gap is all about. It's an imbalance in the market because the market is always supposed to be at an equilibrium level, supposed to be balanced. So in a situation whereby we have a large order or a large movement by these structures, there tends to leave gaps behind after. So these gaps are what we call value gap, and we expect market to come back because they are like a magnet in the market, whereby we expect market price to come back into it and fill it fully or partially before moving. So then how do we identify this value gap? Value gap are formed with 3 candlesticks. We have candle 1, candle 2, and candle 3. So the gap between this candle 1 and candle 3, we have candle 1, candle 2, candle 3. So the space candle 1 and candle 3 leave in between that candle 2 is what we call FVG, fair value gap. Let me go into the chart and show you a practical example. Now, it's a very clear example of FVG. So some FVG might not be as wide as this. As wide as this one, I'm trying to show. But this is just an example of a fair value gap. Now, what do we see here? You can see an imbalance in the market. You can see this candle 1. You can see candle 1 here. You see candle 2 here. You see candle 2 here. Then you see candle 2 at the middle. Then we see candle 3 here. So you can see that this candle 1 here and candle 3 leave a space in between this candle 2. And that space is what we call the fair value gap, which you expect market to come back into to fill it before moving. You can actually say price came into it, filled the fair value gap to this level before the market started moving up. That's just what value gap is all about. So all these components are the things we are basically going to combine together and you taking your order. And the last but not least is break of structure versus market structure shift. So I basically explained that one very well in my first video. But let me just do a quick explanation that a break of structure is just basically the break of previous high or previous low in the market. The situation whereby we are in an uptrend and we're having a break of structure to the upside. you're having something like this in the market. Having you're having something like this in the market. Higher high, higher low, higher high, higher low, higher high, higher low. You see that you can see the market keep breaking the previous high to the upside, to keep the previous high to the upside. So market breaking those highs is what we call break of structure. It is taking the structure to the upside. And if it is in the downtrend, you see market creating a lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower low here, lower high. So market breaking the previous low to the downside is what we call break of structure. And the change of character is just basically break of structure to the opposite direction. Now instead of the market to continue going down, making sure to the downside, you see that the market went up and break the previous high, then start moving in the opposite direction. That's basically it. So for us to take a private trade, I'm supposed to combine this other block or breaker block. You are supposed to find your engagement, your fair value gap, your big structure or your MSS, then before you start taking your private trade. You can see also this is present in this very trade. What do we see here? You see our other block, which is the last opposite candlesticks before a break of structure. So we map it out from this last red candlesticks here. After mapping it out, you can see a break of structure here, 2. Then since you have another block, break of structure, 2. We have our inducements / liquidity here, which is this protecting our other block. Because the liquidity that will basically move the market. And last but not the least, we have what we call our other block. Our fair value gap. Fair value gap. We have it here, which we call the magnet. We have this one here. So which gives this our analysis to be a top notch and a plus setup. So just go through your chart, apply this knowledge, and you keep understanding it, and you keep getting better in all of this. Thank you, and God bless you.